Morning, everybody. It's Wednesday, March 6th, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. I would like to chime in. Please, drop us a line there in the chat area, and we'll be sure to get to it during the show. Now, quickly here, overnight markets had May corn unchanged at 426 1/4. May soybeans were down a penny and 3/4 at 1147 1/4, and May Chicago wheat was down 3 1/4 at 547 3/4. Good morning, guys. We were talking a little bit here before we came on air. Great conversation yesterday that sparked a lot of discussion as we were talking about banks yesterday morning. And we've had, a number of our partners within the industry reach out yesterday, just talking more and more about that and some of the things that are possibly a carryover, whether it's debt restructuring or, changing in rates. So I'm going to shoot it over to Justin. I know you had a couple of those conversations, and I think we'll throw it around the room, but I think this is becoming more and more of a talking point, certainly as we go into the rest of the spring here.
Yeah, Dan, I mean, we've had, several clients calling after yesterday's segment. We've had multiple conversations, which, obviously led into these discussions to start. And I think it's just kind of reverberating, kind of what we were saying more on the difficult time, the speed that we've gone from, really positive P&Ls, cash flows to negative ones in such a quick amount of time. The time of year, like we talked yesterday, where crop insurance expired, a lot of people felt, well, we had this big break, let's store it or pay for storage, even in a lot of cases, to catch this seasonal rally. And obviously we had a counter-seasonal sharp break, as we all know, and it just kind of turned a lot of people's balance sheets, working capital kind of upside down. And now we're going into, loan renewal, and there's a little bit of panic setting in. And so that's kind of what's spurring these conversations. I think something that was brought to light to me that I hadn't really considered is that when we were in that, 7-year period that we talked about from, call it, late 13 into early 20, there was a lot of, debt restructuring at that time, where there was tight margins, compressed margins, a lot of growers kind of running in the red there for multiple years. And a lot of that debt was, repackaged, that debt meaning those, 1-year operating lines kind of got rebundled. I know every bank and situation was different, but generally rebundled and pushed into a 5 or 10 or longer duration note. But the positive of that was that we were pretty low interest rates, obviously. And a lot of that was not paid down in this 2 to 2.5 year run up. Instead, new machinery was financed, and times were good. Kind of like, here we go again, is what we're hearing, right? So now, being in that situation where you still had some of that debt from 5+ years ago, it makes it more challenging the second time, especially at these interest rates. The other thing that I didn't consider or think about as much is, a lot of that kind of debt is on adjustable rate, and a lot is, between 5 and 10 year duration, adjustable, with most being probably 5. So, that puts you a year to 2 out of, some tranches of that may adjust from something like 4% to 8 or 9%. And so, don't know the answer here, just kind of trying to think of what that could mean, what kind of situations that might put the industry in, the next 30 to 45 days, how widespread is it, things we're trying to figure out, don't necessarily know the answer to, but we've heard enough evidence of it that it's not, a 1 or 2 off cases. So.
Well, it seems to me, Justin, that in things I'm hearing is that there's going to be, you hate to use the word oversight, but there's going to need to be a process or plan put in place to help these individuals, whether it's better reporting functions or different risk management packages put together. I mean, there's just different things that are going to be pseudo required now to get these guys back into a better position.
Yeah, I think so. And what we've heard from, several different banks that we work with is that this will be something, there will be more covenants in place. There will be, especially if you've really taken a hit on some of your financial ratios, your working capital, debt reservice, some of those types of things, there will be covenants to try to get you, you need to go from here to here in this next year. Otherwise, there's going to be a lot more serious conversations, meaning not just, you might have to free up some assets, sell some assets off, some uncomfortable conversations. So getting that feeling that it took the industry a little off guard on how fast it happened. I think, there was worry going into harvest, but then, that there's a big difference between going from 6 to 5 and then from 5 to 4, like we just did. So I do think there's gonna be a lot of those situations, especially as we wrap up, end of March, April, where those final deals are kind of getting redone, where there's going to be more covenants, more things that have to happen, so that a year from now, it's not a really tough story or tough discussion to have with the bank. So again, I don't know percentage wise or how widespread it is, but we've heard it from, anywhere from the eastern belt to the western belt. So we've heard it, spread out. Like I said, some banks totally getting out of the industry. So we have even good loans or good clients with good loans, good history that are just looking for new banks because of some bigger, blow ups or problems that have happened that caused the bank to just want to get out altogether from financing operating loans. So, again, we'll probably hear more and more as we get later into the spring here.
I think too, Justin, on the flip side too, the guys that have really good practices in place, or are reporting and have the ability to report good balance sheets, well put together balance sheets and cash flows and risk management, they are getting, from what we're hearing, they are getting rewarded at these banks, in a lot of instances, because I don't know if it's less time needed or what it is, but they're getting rewarded now for doing some of these things.
Well, when there's a fire in the kitchen, you don't go start spraying down your upstairs bathroom. Right. I mean, so anyone that's relatively good, they're going to try to, focus on the problem areas first, right? So anyone that's a high risk or, moving towards a higher risk or loan, obviously those are going to get the most attention right away, and the ones that are relatively good are going to have a much easier time, obviously. So yeah, I think and this is nothing new. If you have really good practices and really good documentation and can show your worth as a loan, you get rewarded for it. And I think in hard times it's especially noticeable, right? When you have $6 corn and everyone's relatively doing well, everyone's treated pretty, everyone kind of turns a blind eye to making a loan. But when things get tough, the ones that, let's say when the tide goes out, you find out who's not wearing any pants, right? So right. That's what we're seeing right now.
Definitely. No, it's good stuff. And go ahead, Dust.
I was going to say, from a learning standpoint, if you're in a repetitive cycle of ups and downs, which I understand agriculture has its sets of that, but looking in the mirror and saying, okay, what do I have to do to change this? And we all of us have been through this from a trading standpoint of you're looking at this going, I know how to make money, but do I know how to hold on to it? And that sort of mentorship for me was priceless in being able to survive and thrive early in my trading career. So, I meet with a lot of people and I see that, hey, you're a good farmer. You make a lot of money, but you have to be willing to change sort of the cycles of how you go about things. And I think that's kind of gotten us to where we're at with the potential negativity of the banking stuff that you guys are mentioning. And it's a discipline of separating the two.
Well, Ben, to that too, like 5 years ago, internally, we talked when we were in this last kind of tough environment, we talked about, the biggest risk to farming right now would be if interest rates were to go sharply higher. Thank goodness they're really low, and those kinds of things. Then at the same time that we had a massive move in interest rates, luckily corn and soybean prices skyrocketed, right? So it's kind of like, oh well, luckily these things have happened. Well, we all know that corn and bean prices, those move, much more up and down than say like bigger term things like interest rates, input costs, logistical issues. So inflation's pretty sticky, especially on the input side. So a lot of things kind of happen that maybe didn't make us be as good a stewards of, profitability as we should have been as an industry. So here we are. And now what? I think one thing that will be interesting is how it reacts with, the positive is that you have all-time high land prices. So people that are sitting on a lot of assets, but also a lot of debt, they may be looking at, and we've heard this anecdotally, but looking at selling some, if you're 70 years old, you've got a lot of net worth on paper, might want to, sell some land out at all-time high prices to pay down some of this expensive debt with high interest rates. So I think we could see lots of versions of that in the next 12 months as well, which would make sense. Like, why pay, 8% plus interest when you have, some assets that you could free up to clean that up and make a clean business. So I know that's a painful thing to talk about, selling land, but the benefit of it is at all-time highs, right? The worst case scenario would be if you had to sell land and they were on, 30%, dip in prices or something like that. So I think that'll be an interesting trend to watch too.
Yeah, no, that's really good points. We'll pivot here just a little bit, guys. We got a USDA report coming up on Friday. By all estimations, it's not generally a real big mover of the needle, but one thing that I think needs to be highlighted, maybe it's becoming obvious to the trade, is that the write down in South America, which I think is interesting because some private analysts are, softening their stance on drawing it down because of improved conditions, while others think it was just a foregone conclusion. So I guess kick it around just briefly here, guys, about what our take is on overall that number, because that appears that that's the number that's going to be looked at, on Friday.
Yeah, South America, we've seen some private analysts that are down in the 140s now. In some cases, USDA still at 156. This is for their Brazilian bean production estimate. So their weather was obviously, it's dry to start. They got some timely rains. It will be very important thing to watch. I think probably the most important part of that report will be Brazilian bean numbers. Otherwise, yeah, traditionally March, we still don't have new crop numbers in there yet. And we're heading towards arguably one of the most important reports of the year, which is March 28th. And that will be the planting intentions and March 1st quarterly stocks reports. So I think that will be the bigger mover of the month, but still something to watch. The USDA's opinion about Brazilian bean production, is that what the market's all waiting for? USDA economists' opinion of that? I don't think that their data is going to necessarily be a lot better than anyone else's for boots on the ground type data. But still could be a reminder to the market of, if they do start sharply reducing that or they don't reduce it, it could take beans and be the leader.
Yeah, that's good points. Yeah, I just wanted to get your opinion quickly on that. Rylan, are we seeing any cash trade come to fruition here in the livestock markets? What do you got going over there?
Yeah, very little so far, Dan. Just a little bit of 183 yesterday in Iowa. So generally kind of steady-ish for right now. I think the trade is going to be looking for that to pick up today. There really hasn't been much news to shake us out of the range right now. We had an inside higher close for April yesterday. We're just kind of struggling to make a new weekly high or a new weekly low at this point. So we just got just kind of caught right now. I really do think that there's a bit of caution right now, and it seems a lot of the fund participation right now, a lot of the specs have been leaning more towards the hog market. It just seems with all the news outside in China about reduction in their breeding herd, and the stories around the U.S. about Smithfield reducing their breeding herd, it seems like the longs really want to kind of stick to the hogs. We've been seeing, at least on the Commitment of Traders report, that they're carrying a bigger hog position, net long hog position than a net long cattle position. I mean, obviously that can change, but it just seems interesting considering the cattle story is so bullish, from an expansion standpoint. So there may be a little bit of caution here, but overall it does kind of seem like at least right now, especially in the hogs, there's this big roll going on, and the April-June spread has just absolutely collapsed. So it seems like the longs are really moving there. It just made a new low for the move, and just huge move just in the past 5 days. So I think that's something to really kind of keep an eye out on. I actually kind of like that, maybe as a spec trade. So just keep an eye on that. I think it'd be kind of interesting to see if we do see a bit of a bounce back once this roll is complete. But as of right now, it just seems like we're carrying this big premium in the market here relative to cash, and we're waiting to see if that can catch up seasonally.
Very good. Appreciate that, Ryan. We just came into the open here. We got May corn down a half at 4.25 3/4. May soybeans down 3 1/4, 11.46 1/4. And May Chicago wheat is down 2 at 5.49. We are streaming live every day on X, Facebook Live, and YouTube Live every day that the markets are open at 8:15 Central Standard Time. We'll be back tomorrow morning. We got export sales that will be out, so we'll go through that and then build our way into the report on Friday, and certainly see what happens directionally. Looking at outside markets, one thing to point here this morning, we got real strong outside markets. The Dow's up almost 270 here. So nice to see a little pop in the outsides. If anybody has any questions, want to reach out, certainly as we're talking about crop insurance or anything market related, reach out to us, info@agyield.com. Hope everybody has a great day. We look forward to talking to you tomorrow.
Thanks, Dan.
Thanks, Dan.